How safe is Cardinal Health's dividend? On August 8, 2019, Cardinal Health reported fourth quarter earnings and full year results for the period ending June 30, 2019. This video provides an update on the company's dividend safety using its most recent operating results. Before we begin, I invite you to subscribe to our channel and like this video, which will help more people discover Sure Dividend's investor education efforts. With that out of the way, let's dig into Cardinal Health's dividend safety. To begin, let's talk about Cardinal Health's business model. Cardinal Health was founded in 1971 and is one of the largest healthcare supply companies. The company serves over 24,000 pharmacies in the U.S. and more than 85% of the country's hospitals. Cardinal Health distributes branded and generic drugs and consumer products to hospitals and other healthcare providers. The company also distributes medical, surgical, and laboratory equipment to hospitals, surgery centers, and clinical labs. Cardinal Health has a market capitalization of $12.3 billion with annual revenues of $146 billion. Cardinal Health is one of the world's most popular dividend growth stocks. The company's current dividend yield is 4.4%. Moreover, Cardinal Health is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 34 consecutive years. Because of this, Cardinal Health qualifies to be a member of the Dividend Aristocrats, an exclusive group of dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors interested in owning Cardinal Health stock will likely be interested in the safety of the company's dividend payment. For the remainder of this video, we will discuss Cardinal Health's dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. Cardinal Health's dividend safety relative to earnings. First, let's discuss Cardinal Health's dividend safety in the context of the company's current earnings. In the fourth quarter of fiscal 2019, Cardinal Health generated adjusted earnings per share of $1.11, which compared favorably to the $1 of adjusted earnings per share in the same period a year ago. For context, Cardinal Health currently pays a quarterly dividend of 48 cents per share, which implies a payout ratio of 43% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Cardinal Health generated $5.28 of adjusted earnings per share in fiscal 2019. The company distributed $1.91 of common share dividends during the same time period for a dividend payout ratio of 36% in the full fiscal year. Using earnings, Cardinal Health's dividend appears very safe for the foreseeable future. Cardinal Health's dividend safety relative to free cash flow. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Cardinal Health's current dividend payment to its free cash flow. Cardinal Health generated $506 million of cash flow from operating activities in the fourth quarter of fiscal 2019 and spent $180 million on capital expenditures during the same time period for free cash flow of $326 million. The company distributed $142 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 44%. Looking out over a longer time horizon, our conclusion is the same. Cardinal Health generated $2.7 billion of cash flow from operating activities in fiscal 2019 and spent $410 million on capital expenditures for free cash flow of approximately $2.3 billion. The company distributed $577 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 25%. Using free cash flow, our conclusion for Cardinal Health's dividend safety is the same as when we used earnings. The company's dividend is currently well covered by free cash flow, and we see no risk of a dividend cut in the near future. Cardinal Health's dividend safety relative to recession performance. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Cardinal Health's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Cardinal Health's performance during this time period is shown here. 2007 adjusted earnings per share $3.41. 2008 adjusted earnings per share $3.80. 2009 adjusted earnings per share $2.26. 2010 adjusted earnings per share $2.22. 2011 adjusted earnings per share $2.67. 2012 adjusted earnings per share $3.06. 2013 adjusted earnings per share $3.29. Cardinal Health suffered a 34% decline in adjusted earnings per share during the last recession. The company did not make a new high in adjusted earnings per share until 2016. More importantly, though, the company's earnings still covered its dividend payment, and Cardinal Health continued its multi-decade streak of dividend increases. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. Cardinal Health's dividend safety relative to its current debt load. The last angle that we will use to assess Cardinal Health's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest would have to increase before its free cash flow would no longer cover its dividend payment. At the end of the fourth quarter of fiscal 2019, Cardinal Health had $8 billion of total debt outstanding. The company generated $67 million in interest expense in the most recent quarter for a weighted average interest rate of 3.3%. The following image shows how changes to Cardinal Health's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Cardinal Health's weighted average interest rate would need to rise above the 5.5% level before its dividend would no longer be covered by free cash flow. Although this is lower than we would prefer, we have little concerns about the impact of the company's debt on Cardinal Health's dividend safety moving forward. Looking out over a longer time horizon, the dividend appears very safe. Cardinal Health generated $294 million in interest expense in fiscal 2019 for a weighted average interest rate of 3.7%. The following image shows how changes to Cardinal Health's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Cardinal Health's weighted average interest rate would need to rise above the 25.3% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on Cardinal Health's dividend safety moving forward. In conclusion, thank you for watching today's video, which performed a deep dive on Cardinal Health's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at suredividend.com.